let's take a look at how to compute weighted average cost of capital. And suppose we have a firm that has two items in its capital structure. It's got equity and it's got debt. It's got common stock and it's got one bond out there. If that's the case, the name kind of gives away what's going on. It's a weighted average cost of capital. We've talked about how the cost of capital are the expected returns that the investors require. So there's your cost of equity, there's your cost of debt. Your cost of debt is equal to the yield to maturity on the debt. The cost of capital on the equity is equal to just the expected return on the equity. The cost of debt, because of the tax implications, the after-tax cost to the firm needs to be taken into account. So while the investors may demand 10%, if there's a tax rate of 40%, the 10% that gets paid out lowers taxable income and there's a savings. And it's a weighted average, so you want to make sure to take into account the relative weight between how much equity is out there and how much debt's out there. And so you've got E and D, which are just the market values of equity and debt, the number of shares outstanding times the price of that stock, the value of each unit of debt, each bond, times the price of each bond. Add them up to get the market value of the capital structure, which is the market value of the asset. So again, hopefully you can see we've got our balance sheet, and we're taking a look at the expected returns of these guys, the after-tax expected returns, taking into account their relative weights to get both the expected return and the value of the assets. The value of D and E is equal to the value of A, and a weighted average of the expected returns of D, the weighted average of the after-tax returns, gets us the cost weighted after-tax returns gets us the weighted average cost of capital, which is equal to the expected return on the assets, which tells us about the level of risk, which gives us a lot of information about this firm. So that is how you compute the weighted average cost of capital. A couple of notes. When the price and the yield of a bond are given, so you're given everything that you need in order to compute weighted average cost of capital. If you were to try to back out the time to maturity, you might see that it's not necessarily a whole number of years. In those cases, the time to maturity is not relevant. The pieces that you're given, the yield and the prices, that's what you need, that's what's given. So I bring this up to point out that even though if you were to back it out, it'd be different than anything we've done, it's not creating a new thing in the class because you don't need to know the time to maturity. If you have a situation where you need to compute the yield or you need to compute the price of the bond, then you'll get the time to maturity, and that will be a whole number of years. So if you ever need to compute yield or bond, it'll be consistent with what we've done all semester long. So I just point that out, that in case someone were to back out the yield to maturity or the time to maturity and realize, oh, it's not a whole number of years, something's going on here, something's not going on there. It's that this gives us freedom to give you prices and yields that sometimes work out real nicely. So let's take a look at an example. We've got Lasco, company stock, company bonds, and a tax rate. And the question is, what is the weighted average cost of capital? And so we want to take a weighted average of the expected returns of stocks and bonds. So the first thing is to figure out what's the value of the stock and the value of the bond. So here we can see we have 1 million shares, and we're interested in the market price. So we have 1 million shares at $20, so $20 million of common stock. Bonds, there's 16,000 outstanding. Face value and market value, we're interested in the market value. 16,000 times 1,000 is also 1,250 is also 20 million. So if you owned all the stock and all the bonds, you'd have $40 million worth of holdings. And owning all the stocks and all the bonds is equivalent to owning all the assets in the sense that all of the cash flows that are left after the employees and the suppliers and the government get paid would go to the would go to you. The debt holders would get, their interest payments, and then whatever's left over would go to the equity holders. If you owned all the assets after the suppliers and the employees and the government got paid, you get to keep everything that's left. So they're equivalent. Expected return of 12%, expected return of 8%. Corporate tax rate's 50%. Is that relevant for stock? No. Is that relevant for bonds? Yes. So you can see there's 40 million total in capital structure. So 20 of the 40 is in the form of equity, which has an expected return of 12%, plus 20 of the 40 is held in bonds, which has an expected return of 8%, but because they're bonds, they're debt, there's tax benefits, so the cost to the firm is only half of that, because let's say they pay out 8%, that lowers their taxable income by 8%, 8 percentage points, and therefore the tax rate's 50%, so they get to save half of that in taxes. And if you do the math on that, you find out that the answer is equal to 0.080, 8%. And so here's the solution of everything that we just did. What did we just learn? What we learned is a bunch of things. We learned that Lasco assets are worth $40 million. We learned that they have an expected return of 8%, which means they're just as risky as stocks and bonds that have expected returns of 8%. And if those assets are expected to have a return of 8%, that's enough such that bondholders who own $20 million worth of holdings can expect a return of 8%. And shareholders who also have holdings of 20 million can expect a return of 12%. And again, the reason why an expected return of 8% can provide 8% to some and 12% to the other is the fact that the 8% to the bondholders doesn't actually cost them 8%. It actually costs them only 4%. So again, you can see we didn't just run through a mathematical exercise. We learned a tremendous amount about the value of Lasco assets, the expected return of Lasco assets, which in turn tells us about the risk of Lasco assets. And the way to think about it is that the return on those assets is just enough so that the expected returns of the bondholders and the equity holders are consistent with 12% and 8%, given the fact that in this case 20 and 20 was debt and equity, was evenly distributed. If you had different weights on that, things come out differently, but it shows how much we can back out by looking at this side of the balance sheet, which is information in the real world that's readily available, and that we have some really nice finance tools to allow us to value, to back out expected returns, and to do some really good things with.